From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Wednesday, March 23rd. Here are the top market stories we're following for you at this hour. Bonds catching a bid. Global bond returns have dropped 11% from a high at the start of the year. Today, they might make a comeback. President Biden, he heads to Europe. The president set to meet with European allies to discuss the tough on Putin messaging and hawks everywhere. More messaging from the Fed, while Wall Street calls for 50 and even 75 basis point hikes. We speak to San Francisco Fed President Mary Daly. From New York, I'm Kriti Gupta with Guy Johnson in London. Alix Steel is off. Welcome to Bloomberg Markets. Guy, it's all about the bond market right now.
It is. You wonder whether there's some dip buying in the bond markets. Can't quite believe I'm saying that, but maybe that's actually what is happening today. How long it lasts, we'll wait and see. We're getting a bit of data hitting the Bloomberg terminal, Kriti, so let's just bring everybody that, and then we'll dig into the question of what happens next with the bond market. New home sales coming through a little light at 772K. On the month-on-month number, last time round, negative 4.5. That's been revised lower, negative 8.4. So some slowing down in the U.S. housing market, negative 2 this time round. Interest rates are starting to rise. Supply is limited, but starting to come back. So maybe we're starting to see some relief there. But it'll be interesting to see what happens with the housing market. The transmission mechanism from the Fed to the housing market, maybe it could work a little bit faster. But let's get back, Kriti, to our question of the day. If you're selling bonds, which isn't happening today, what do you buy? Let's bring in Bloomberg's Kayleigh Lyons, making another guest appearance, and Bloomberg's Marcus Ashworth joining us from Bloomberg Opinion. Marcus, let me come to you first of all. I was going to ask you if you're selling bonds, what are you buying? But let's talk about buying bonds. Is there a dip buying opportunity in the bond market?
Spot on. And the whole point is, if you want to get into this trade of moving out of bonds, you want to do it at the right opportunity. And I don't think it's now, for a couple of reasons. One, we just had this massive sell-off. So therefore, I think there's a chance of a little correction at least. I'm not saying the trend isn't in place. It clearly is. But we will find a range. At the moment, we're probably at the point of the top of that yield range at the moment. And secondly, it's Japanese year end. And that often is a period where you see a lot of selling into it. And then instead, they'll start buying again quite actively. So I think timing-wise, this is probably not the best time to exit bonds. Equally, if you do exit bonds, there are other types of bonds you can buy, like floating rate notes, which may offer you a little bit more of protection for yields because they'll go up as yields go up. And I think that's the other thing. You don't have to go out of bonds. The 2-year yield on US Treasuries is very attractive. So there will be some dip buying on that anyway. And then there are also other sort of dividend type stocks or bond-like equities to go into as well.
Well, let's get Kayleigh Lyons into the conversation here. Kayleigh, I'm curious what the bond market moves mean for the equity market, because it does seem like, to Guy's point and to Marcus's point, there is this trade-off. If you're not getting returns in the bond market, maybe you hop into equities in this kind of there is no alternative legacy that we haven't quite shaken off yet. What's your take?
Yeah, does Tina live forever, I think, is the question. And that was actually what John Authors in our Bloomberg Opinion piece raised yesterday. This idea that, yes, the Fed being aggressive and rates moving higher, in theory, could be a problem for equities, especially growth equities with those higher multiples. But at the end of the day, it's going to be worse for bonds. So it's all a story of relativity. And if bonds are going to fare worse, then maybe it does drive you back into the equity market. And of course, we're always trying to assign some kind of narrative to the equity action. Why would the S&P 500 be up 5% in the days from Wednesday after the Federal Reserve finally hiked rates? Now there's this idea that maybe that is your inflation hedge, that these companies have demonstrated an ability to exercise pricing power. So if you're looking to hedge inflation and you don't want to be in the bond market, perhaps you do so when it comes to some of these equities.
Kayleigh, do you think that the market, and you've been talking to a bunch of people all morning, and I'm interested to get your take on what they're saying, does this feel like post-fact rationalization? i.e., we're in a situation where we're selling bonds, we don't know what to do, so we're buying equities, and then we're going to justify buying equities by saying they're an inflation hedge?
Yeah, to a large extent, yes, Guy. And it comes back to the idea of assigning a narrative, because at the end of the day, none of us really know for certain why markets are moving the way that they are. But also, it's a story of if people want to stay invested, where are they going to go? So I know your question of the day is, what do you buy? Maybe the other question is, do you want to buy anything, or do you want to stay in cash? That is a question we have been asking pretty consistently in recent weeks. The answer largely is cash in this kind of inflation environment. Maybe not. So you have to go somewhere.
Let's bring Marcus back into it. Guy, I don't know if you know this, but Marcus and I met when he was teaching me what an island reversal was, back into the technicals. I don't know if he remembers that, but it was a couple of years ago. But he does. I never forgot. Okay. Marcus, let's talk a little bit about the direction in terms of bonds. You said that it kind of seems like the direction is kind of set in stone at the moment, the idea that bonds are going to keep falling, yields continuously higher. But what about the geopolitics of this all? When you started to see some of those headlines come out on Russia, on Ukraine, you did see this global bid for bonds and specifically into the U.S. Treasury market. Could we see a revival of that as the war rages on?
Well, we may see a little of this. I said I think this is a pretty good time to buy bonds, or certainly not to be selling them here. And there maybe get some rationalization will be a flight to quality for it. But the reality is it'd just be a bear market rally in that sense for bonds. But I do think you should be buying equity generally, and should have been for the last N years rather than bonds, regardless. So it's a question of your timing here. And that's all I'm trying to say, is that it's about timing. I don't think you should be panicking out of bonds right this moment. You've missed out, I'm afraid. And likewise, buying equities, there'll be better, probably little opportunities to buy it. But, generally speaking, there are ways, as said, of other ways of getting better exposure in bonds. Yep. And I certainly do think also some people, as I said, that 2-year US Treasury yield, it's short. You've got to park your money. It's not going to beat inflation, but it's not going to be a bad place to hide.
OK, I want to come back to the equity market. Has the equity market over the last few years been driven by higher liquidity coming out of central banks? And if it has been driven by liquidity coming out of central banks, doesn't that liquidity being withdrawn necessitate equities to come lower?
No, it doesn't necessitate, but there's no doubt every asset price has gone up because of central bank liquidity. Yeah. And let's face it, not a lot of liquidity is going to be taken out. It's a little bit. And, in essence, there will be a real crack. And I don't think there's quite so much that Fed put underneath the equity market so much.
Doesn't feel like it right now.
No, indeed it doesn't. There's certainly not on the bond market. But there will come a point where there may have to be one. But equally, it's the combination of when they start doing quantitative tightening, we can answer that question. And I think that's the more important point, is where they start hiking rates. Clearly, this talk of 75 basis points, it's not going to happen, but that allows them to do 50. And I think that's the way the Fed have talked the game the last few months has been absolute textbook. They've been by far the best central bank of the major ones, but for sure.
It's a low bar.
Well, indeed.
Marcus, I'm going to throw one last question at you here. Bear with me. You were a trader before you were an opinion columnist. I'm curious about, coming back to our question of the day, if you're not buying bonds, you don't really want to buy equities, is commodities the way to go here despite the volatility? We had a guest on Surveillance earlier saying it's actually good to include commodities as kind of that hedge as a part of your portfolio. What is the investor community really thinking about that?
I would think you've missed your timing on that. Very much so. I don't know enough about commodities to confidently predict that one, but I would say you shouldn't be rushing in to buy commodities now. We had that trade a few years back, I remember, I think 2012, when the CRB index jumped, everyone started twisting money into commodities. It didn't end well. And I'm not sure this one. I think you've missed out on commodities. I think you do buy stocks. I've always preferred stocks over bonds in that sense, and I think that will play out and continue to play out. It's just your timing. You should be taking your time here, not panicking. If you want to move into cash, that's fine, but you should be waiting for opportunities to buy equities at the right point. Still.
Well, good stuff. Marcus Ashworth of Bloomberg Opinion and Bloomberg's Kaylee Lines, we thank you both for your time and for your insight. A quick recap here of those headlines we got at the top of the hour. February new home sales coming in at 772,000. The estimate there was 810,000. So coming in a little short, but we do still know that some of that data is booming, coming a little bit off of its peak. We, of course, watch the rest of the data to see if it follows the same trends. Coming up, stocks halt their fall and bonds stabilize from an unprecedented rout. What do investors do next? We'll talk with Wells Fargo Securities equity analyst Anna Hahn. This is Bloomberg. Back to our question of the day. If you sell bonds, what do you buy? Where do you go? Joining us now is Anna Hahn, Wells Fargo Securities equity strategist. Anna, thank you so much for joining us as always. Let's put that question to you. If you buy bonds, is equities essentially the only alternative, or is perhaps the equity bid a little bit more based on fundamentals? What is your take?
I think it's a mix of both. To be fair, people are always asking, what do I do with this cash? Given the inflation measures, you don't want to just stick it under the mattress. At the same time, when we look at the equity market, I do think that there is a play to be had, given especially Powell's comments on Monday that they're open to a 50 basis point hike. That's going to spur probably real yields. So you might want some of that cyclical exposure in your portfolio.
Nevertheless, if people are buying bonds, are we back into basically having to deal with Tina? There is no alternative, so we have to buy stocks. And we're in a position where, as somebody's just pointed out in an email to me, a lot of funds have mandates in terms of how much cash they can carry, Anna. So if they're selling bonds, they've got to buy something else, and they have to buy equities.
No, it's a fair point. Really, people are wondering, where do I put this cash to work? So for us, we still think there are opportunities in the equity market. And whether it's because people feel there's really nothing else, or there really are some value opportunities here, especially given the massive correction we've had in the beginning of the year. I think that there is still something to be played. Now, our price target is 47.15. It's not very much higher from here, but it's still upward and bullish. So I think if you're going to play, there is equity that you can put into your portfolio, and particularly in more the value oriented, and put a little quality twist on it as well, so that you can weather through any credit stress.
Anna, let's talk about the impact of commodities, especially. We know that margins have had a pretty good run in the last couple of quarters as you start to see a lot of these companies really pass on the cost to consumers. How long are they going to be able to do that when you have forecasts of oil hitting as high as $200 a barrel, food prices continuing to be on a tear? What's your take simply on the pressure that might be put on those margins?
Well, what we've already seen in last quarter with earnings season is that margins are under pressure. With 4Q earnings, you saw margins actually compress a little quarter over quarter, at least sequentially. But that being said, I think that some of the larger companies you saw were still able to pass along price. They were still able to grow some of their bottom line. Now, when you think about the market as a whole, though, the smaller companies did have a bit of a tougher time. So if you're worried about margins, I think that's how you can kind of defend yourself against that. Look towards the companies that have more of that pricing power. They have more size that they can kind of throw their weight around to say. But at the same time, keep in mind that even with higher prices, we've also seen higher wages. And that also helps for the consumer side.
Even the quality names in this equity market, do you think that they are going to produce returns this year that exceed inflation?
Well, when we think about quality, really where quality tends to outperform is in times where we have credit stress or you see credit spreads widening. Now, what's been interesting is with this exogenous shock with the war with Russia and Ukraine, you saw credit spreads kind of widen here. But they've also been coming in the last several weeks. You look how it was versus March, the IG credit spreads have come in from about 140 basis points to maybe 120. And on the high yield side, you saw that shrink from about 400 basis points to 350. Those kind of moves are telling you that there's still risk appetite and credit is still healthy in the U.S. at least.
Okay.
So those are signs that, yes?
Are equities going to outperform inflation this year?
I think for us, look, again, our price target is up about 5% here. So if the Fed really continues with a more aggressive rate hike schedule, I think they still have a chance. But at the same time, it really depends on if the Fed can maintain that aggressive schedule that they do and really bring down inflation and grab inflation and face it head on.
Anna, it seems like there is a lot of meshing of this idea that decelerating growth could very easily turn into demand destruction and then ultimately a recession, creating a very bearish view for stocks right now. What's your take simply on the possibility of a recession, the possibility of demand destruction, and to your point earlier on wages, how much the American consumer and American companies can actually weather that storm?
Well, so far what we've heard from corporates and on the corporate side in earnings is that they are pretty healthy. They are still seeing, earnings growth. And we do expect, at least for the S&P 500 companies, that EPS growth will continue to be positive. Now, that is our base case scenario. Something we have to consider is what happens if this war really spreads and China gets involved. U.S. has a lot more exposure with China. So if they get into this mess and we end up in a situation where perhaps we need to put sanctions and corporates in the U.S., again, more exposed to China, get involved. Now, that could be more of the tail case scenario, but it's something to consider. And that could push us more into dangerous territory. Something to keep in mind as well that people are watching is really the yield curve. And when you see that yield curve flattening and the potential for it to really invert later in this year, that too is something that kind of in the back of people's minds, people relate to a recessionary scenario. And then keep in mind as well, with rates at where they are now, The Fed is raising them, but to have the power to cut and ease on a monetary, we first need to raise rates. So I think that too, those monetary tools being where we are, bring a little bit of concern that if we were to get into that territory, we don't have as much ammo really to help ease markets again.
Anna, how much of the gains of the last few years have been driven by central bank delivered liquidity? And if that liquidity is going to be withdrawn, can't we assume that the opposite will happen?
Well, I think already the market priced in some of that. You saw as we started expecting rate hikes, the market kind of started to slow its upward pace, especially in the beginning of the year. Even before the situation with Russia and Ukraine, you saw the markets were falling and kind of pulling back as we priced in that expectation of monetary tightening. And you're absolutely right. I think monetary easing on top of that fiscal stimulus was really a big driver of equity returns in the past years. So we're going to have to get used to not having that support and really the training wheels coming off the bicycle.
Great to catch up with you, Anna. Thank you very much indeed. Anna Hahn of Wells Fargo Securities. The trading wheels are coming off. It's going to be a bumpy ride ahead. Still ahead on this show, though, Tencent declaring the end of an era. The Chinese social media giant reporting its slowest growth on record. Details to follow. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The world's largest food maker will quit making food in Russia for now. Nestle is suspending manufacturing there. It also will quit selling brands like Kit Kat in Russia and focus on essentials such as baby food. Multinationals are being pressured to fully exit Russia following the invasion of Ukraine. And it's one of the biggest transactions yet in the cannabis industry. Cresco Labs plans to buy Columbia Care for about $2 billion. The transaction will expand Cresco's presence from 10 to 17 states, plus the District of Columbia. Cresco has several well-known marijuana brands. And in China, Tencent has declared that the reckless era for tech is over. The social media giant pledged to embrace the government's new model of stricter oversight after reporting its slowest growth on record. Tencent's revenue grew just 8% in the latest quarter. And that is your latest business flash, Guy.
Very good. Thank you very much indeed. I want to talk more about Tencent. Let's bring in Bloomberg's Ed Ludlow back with us. Ed, I'm really curious as to what is happening at this company. We've had a massive regulatory crackdown. The company's now talking about an era of healthy growth. I don't know quite what that means. Can you dig into the details? What is the picture going forward for Tencent in this new order that it finds itself with?
Yeah, look, we're 12 months into a pretty significant regulatory crackdown from Chinese authorities. And the message from Tencent executives is that they're playing ball. They recognize that there's a new paradigm, they called it, where authorities in China won't accept growth at all costs. What that means in real terms, if you look at not just at Tencent, but Alibaba, others, losses in the past would be covered by the capital markets. They would come in to fund losses. That's no longer going to be the case. So that's kind of the messaging from executives. The fundamentals, this is a really difficult environment for growth. They had single-digit top-line growth for the first time since 2004 when they listed. The ad environment isn't great. And when you combine that macro picture with what authorities are doing, the way that Tencent's business is structured, it meant that they struggled.
So what does this mean? If you can just broaden this out, because we heard from Alibaba yesterday, they were actually increasing their buybacks. They were super confident on where their performance was going. But for investors that are outside of China, that regulatory crackdown is still kind of this providing an overarching shadow. So what do investors do with that?
Yeah, it's interesting. And on buybacks, Tencent kind of declined to comment during the earnings call that they have no plans to initiate a buyback. And the read from the street is that the bottom line is very messy with Tencent because of what's going on, right? That they beat on net income, 3 times profit what the street expected. But they also divested JD shares, and the market's kind of looking at this company and thinking, what is the problem? What is the fundamental problem? Well, they're having to comply with really strict regulation. For example, on the gaming side, gaming is 30% of revenue. but it only grew by 1% in terms of that top line growth. You see there the profit that I was talking about. Yes, it was triple the estimate, but it all came from a one-time gain of divesting JD shares. What it all comes back to is, where does growth come from in the future for this company under this new paradigm?
Where does it come from? Advertising, tough. Gaming,
yes,
tough. Fintech, okay. Is that the future here?
Yes, but how do they manage it in the context of regulation? Yep. So if you take fintech, for example, and WeChat, those businesses did really well, but they're also under the spectre of regulatory scrutiny. So for example, on fintech, the company talks about having to work more closely with authorities and perhaps even set up a separate financial holding company to exploit growth in that business. On gaming, we're about 8 months into a license halt. The Chinese authorities won't allow new titles to be released, partly because of child protections, but also because of the broader regulatory crackdown. The good news, Tencent says, is there's a pipeline of content in the domestic market which should boost growth in the second half of this year. Very finally, how are they managing the situation in China? Tencent is looking outward. It's trying to grow its international business, but to do that, they are having to invest, and that's having an impact on margins. The good news, they say, is that in this new era of healthy growth, this new paradigm, margins will be stable, even if you don't get that top line growth. And as we know, guys, everyone is hungry for that top and bottom line growth.
Yeah, Ed, there are about 30 seconds here very quickly. I'm curious about that growth, like you mentioned, outside of the country. Where else can Tencent really go to kind of optimize its brand essentially around the world? What markets aren't they tapping here?
Yeah, gaming is a big part of that. So, for example, working in collaboration with international brands like Electronic Arts, working as a publishing house, investing in talent outside of China. Those are all elements that the company says they'll double down on. But again, you've got to spend to make that happen.
Well, fascinating stuff. Bloomberg's Ed Ludlow, we thank you so much. Coming up, President Biden, he's off to Europe, where he'll try to persuade U.S. allies to impose tougher sanctions on Russia. What does that mean? How do you trade it? We'll, of course, talk to an expert, Henrietta Trey's of Veda Partners. She's the director of economic policy research there. She joins us. That conversation's coming up next. This is Bloomberg. We're an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. A little bit of red on the screen, Abby.
A little bit of red on the screen, but it's hard to know whether or not it will last. It sort of seems as though we may see a move back toward the rally we had yesterday and last week. Right now, though, the S&P 500, to Creedy's point, down about 0.4% off of the lows. And again, there's this sense, if you take a look at the shares of Apple, which are higher, up more than 1%, that maybe Apple, because of its big weighting, could lead the S&P 500 higher. Right now, interestingly, we have bonds bid just a little bit, that 10-year yield coming in 2 basis points after this monster move higher. One day a trend does not make. So we'll be keeping our eye on that. Pressuring stocks, most likely oil up 4.3% on some of these headlines coming out of the Russia-Ukraine war. And then copper also bid. So the commodity complex in general well bid, as it has been this year. If we take a look at one of the mega cap tech stocks, the surge in yields hasn't been holding all of them back. In fact, take a look at Tesla in the month of March. This is really pretty incredible. We have this 34% rise. Earlier in the pre-market, it had been down after yesterday's 8% rally, but now it is higher again, up and away. That's true, too, for the meme stocks. Remember them? The meme stock mania is back. If we take a look at the shares of GameStop, up 14%. This after Chairman Ryan Cohen upped his stake to 11.9%. The activist investor, also the founder of Chewy, it seems he has a very good way. Everything he touches turns to gold. Investors want back in on that stock that was up 700% last year. Speaking of up 700%, Guy, this is pretty amazing. I actually had not heard of this one. Dan Curtis, our producer, put on Mullen Automotive on this board, up 4.4%. In the month of March, this stock is up 700%. So again, meme stocks, they're back.
Absolutely. That's quite the rise in this kind of environment. Abigail, great stuff. Thank you very much indeed. Might come back to that one. I want to break a bit of data that's hitting the screen right now. crude oil inventory data out of the United States being watched very carefully at the moment. The inventories fell by 2.51 million barrels, this according to the EIA. Bloomberg does a survey coming into this number. It was expected to fall by circa 600,000 barrels. So we are many orders of magnitude higher in terms of the draw that we're seeing here. Pay attention to this. Obviously, what is happening with crude right now is that we're seeing significantly higher prices. We're through 120, again, nearly 121 on Brent. So we're once again seeing oil prices rising sharply. Then you're going to throw in the geopolitics. The debate in Europe about whether or not we are going to see oil sanctions, gas sanctions being applied to Russia is raging right now. About to enter that debate is President Biden. He's on his way to Europe right now. He took off a little while ago from Joint Base Andrews. He is now on his way across the Atlantic. He's going to have summits in Brussels with European and NATO leaders. Plus, he is then going to go to Poland. Obviously, Poland front and center in this growing refugee crisis. And Poland also front and center when it comes to the issue of sanctions, very much at the hawkish end of the spectrum. Let's go to Poland now. Aggie Cantrill joining us now on the border of Poland and Ukraine. When the president arrives in Poland, what message is he going to be given in terms of what more needs to be done to hit back at Russia?
Hi, guys. So as you say, Poland is definitely on the hawkish end when it comes to the European Union's position on sanctioning Russia further. Poland sees Russia as a security risk to themselves as well, and they're keen to push this themselves. And Poland is itself very reliant on Russian gas, but the Prime Minister Morawiecki and other Polish leaders have already pointed out that they are doing their best and have been doing before this crisis. They've been pushing to wean themselves off Russian gas. That has been a strategy for a while now within Poland. And so the 55% of their gas market, which is currently reliant on Russia, they're trying to wean off as quickly as possible. And so it's clear that when Biden comes to Warsaw, he'll be met with a very hawkish message on Russian sanctions from the Polish authorities.
Aggie, there's some comments here from Russia. Russia saying the expulsion of diplomats from Poland won't go unanswered. My question to you is, what are the consequences of that? Is there something that Poles are particularly bracing for when it comes from Russia?
It's not really clear what Russia meant by that it won't go unanswered, but it might be something like the tit-for-tat expulsion of diplomats. But when it comes to those diplomats itself, it's important to notice that this isn't just a Polish concern. There has been a clampdown on espionage from the Russian side in the EU, especially in Eastern European nations, because they see this as a security risk. They have stepped up counter-espionage operations against Russia, and this is also a clear concern to Poland, which borders Ukraine, has a large land border with Ukraine, and they see these sometimes that there is a possibility that there could be further risk to their own security with the war going on in Ukraine.
Bloomberg's Aggie Cantrill joining us from the border of Poland and Ukraine. We appreciate your reporting so much. For more on President Biden's trip to Europe, we welcome Henrietta Treys, Veda Partners Director of Economic Policy Research. Henrietta, thank you as always for joining us. My first question to you is, we know that sanctions are very kind of tough when it comes to actually sanctioning energy and other commodities, just given the dependence on Russia. But what about tariffs? What is the take from Washington on tariffs when it comes to addressing the commodity space?
Great question. And as we know from the 2018 to 2020 period, there is unlimited, basically, capacity at the administration level to shift tariffs around, to impose new tariffs, to carousel through a rotating basket of tariffs. And that's something that the Speaker of the House has introduced in the last couple of weeks to strip Russia and Belarus. I've even heard that there are some in the Democratic caucus who would support stripping China as well of their permanent normalized trade relations status, which keeps them in the column 1 category of tariffs across all goods that are imported. So that's everything from alloys, agriculture commodities, imports of shoes or backpacks or whatever particular product lines can come in. And the differential between column 1 and column 2 on the harmonized tariff schedule is robust. 2.5% is the import tariff on a number of goods coming in from Russia, if not zero, if you're in the PNTR status. If you moved into column 2, you can see that rise to 18.5%. 45% or even higher. And that discretion is something that they will leave with the administration to permanently be able to cycle through as they see fit and as the war escalates. So the tariff move in particular is something to be watchful for, something we're advising clients to expect to come once the Senate passes their version of the bill as early as this week.
Henrietta, when it comes to realpolitik, though, do you think tariffs are going to be enough to dissuade Vladimir Putin? The administration is making it very clear that this is not going to become a hot war. Without that kind of commitment, do you really think that Russia is going to be deterred?
Well, I don't know that deterrence is something you can get just from tariffs. That's why you're seeing the sanctions spread across individual oligarchs, across the capital market space, banking, kicking them off SWIFT, kicking them off the dollar clearing exchange. Yeah. This is something that also has a carrot component. And so you also want to watch that piece. The long-term viability of Russia is tethered to their energy sector. It's a near-term hit to the EU, to a much limited extent to the US as well, from the energy, the LNG perspective, natural gas. But when you are evolving off of that reliance and the reliance on fossil fuels by, say, reducing or even increasing ethanol requirements to make more corn, more soy go into your blend, those are moves that the administration can take that permanently harm Russia in the longer term, while not an immediate deterrent like say, implementing a no-fly zone that would obviously escalate and cause the United States and NATO allies to go to war with Russia directly, which is something everyone wants to avoid at this point. So it's a deterrence for the long run. And the near-term deterrence, obviously, is focused on shifting personal opinion inside of Russia, hitting the oligarchs, trying to jam them up as much as possible. You're eliminating trillions of dollars in wealth in the blink of an eye. Across the top elite sectors of Russia. And so that's another piece of deterrent. But this is wholesale economic warfare.
Henrietta, talk to us a little bit about the timeline here, because you do have messaging coming from Washington, the idea that cyber attacks might be coming, chemical weapons might be deployed, a lot of this idea that a lot of the infrastructure needs to be built, but that all takes time. What is the perspective in Washington when it comes to the timeline of how long this conflict will actually last? Are we talking about weeks, months, years? What's the take?
The way that they're observing this war and this invasion is to throw everything at the wall, which suggests that they are anticipating that this will continue for a while. When we start talking about creating a situation with Spain where they buy our genetically modified corn for the first time in hundreds of years, that's a long haul commitment. And this is, I think, going to be permanent as far as Russia is concerned for the foreseeable future. And the question is more, do we incorporate China now, or do we wait to see them institute some sort of an invasion of Taiwan or keep that distinct? As of this moment, what you're seeing from the Ambassador Tai, for instance, at the USTR, a new trade agreement reached with the UK to shift steel and aluminum tariffs off, take those 25% and 10% tariffs off after the Trump administration imposed them. Those are material sea changes building on her efforts with the EU and Japan. They are in this for, to put it from a timeline perspective, quite a while at this point. And I would anticipate it is the most prominent factor of Biden's administration for the remainder of this term, which is obviously another 2.5 years.
Biden's on his way across the Atlantic right now. He's going to land in Brussels a little bit later on. He's got an EU summit to attend. He's got a NATO summit to attend. He's then going to be going to Poland. What is the objective of this visit right now? Is it to provide help and assistance to the EU on the energy front? Is it to coalesce the unity of the group? I'm just kind of wondering what is a win for Biden on this trip?
It looks very much to me, based on the posturing I'm seeing from the administration, that we are expecting to see some material sanctions updates delivered from this next couple days worth of travel to Brussels to Poland. That's going to include everything from giving an optic of the NATO allies all being together, something we have not gotten yet. So that I think will be very optically impactful, continuing to rally support amongst embattled EU allies who are dealing with critical gas price hikes and shortages, and then also keeping optimism and support alive here in the U.S., where support for these sanctions is very high and it's going to need to be managed for the future, particularly as we battle inflation here. But what I'm sensing from Jake Sullivan and from other leaders in the administration's office is that an announcement on energy policy is forthcoming. I think there are a number of options here. You could see increased production in the United States announced. We all know that Democrats have been talking about maybe the Defense Production Act requiring more production, hearings to talk about what the energy companies are doing in terms of pricing. We all know that that's something that's left to the gas companies individually, localized around the nation. But I think it's going to be most importantly for the investment community, some sort of an announcement on the energy front, which is going to do with increased supply. And then also carrots, as we mentioned, whether that's from allowing the E15 standard or ethanol subsidization, the blending requirements to shift, things along those lines is what I'm expecting.
Henrietta, really insightful. Thank you very much indeed. Henrietta Trays, Vader Partners Director of Economic Policy. Thank you very much indeed. Coming up, I want to come back to those crude inventory data which we've got. It's really worth digging into these numbers. So crude inventory down by 2.51 million barrels according to the EIA. US, to the point we've just been making, US gasoline exports have climbed to their highest level since 2018, according to the data that has just been released. The US is exporting significantly more energy over the last period. Will that continue? Judging by what we've just heard, I think the answer probably is yes. We'll get more on these inventory data in just a moment. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Thomas DiNapoli, the New York State Controller. That's at 1 p.m. in New York, 5 p.m. in London. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Russia's climate envoy has become the highest level official to break with the Kremlin over the invasion of Ukraine. Bloomberg's learned that Anatoly Chubai has stepped down from his position and left the country. Chubai is one of the few 1990s-era economic reformers who'd remained in Vladimir Putin's government. And one of the two flight recorders from the China Eastern plane that crashed Monday has been found. That's according to China's official news agency. The black boxes are key to figuring out why that Boeing 737-800 plunged out of the sky at close to the speed of sound before crashing. Moderna says its coronavirus vaccine produced a strong immune response in children under the age of 6. The large final stage trial showed modest effectiveness in reducing Omicron infections. Based on the results, Moderna will ask regulators in the US and overseas for clearance of the vaccine as soon as possible. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy Critty.
Well, Ritika, thank you so much. Let's get to the oil story. Latest U.S. government data shows crude stockpiles fell by a little more than 2.5 million barrels. Let's get more on those numbers. We're joined now by Sheila Tobin, Bloomberg Energy reporter. Sheila, thank you for joining us as always. We saw the stockpiles drop, but I think we also saw exports climb quite a bit, given just the geopolitical situation. Can you walk us through those numbers?
So you rightly pointed out that the export numbers did go up significantly. I mean, that's in part because WTI, which is the U.S. oil benchmark, it's been trading at a significant discount to international Brent crude oil. So when that happens, usually a buyer or a refiner will want to choose whatever's cheapest in the market. They will try to look out for U.S. or WTI linked crudes, and that's probably one of the reasons why we're seeing these rise in exports. That's right.
Let's talk a little bit about what's happening in the U.S. economy right now. What can we deduce from the data? What is the demand picture?
Well, right now, I think demand has been pretty steady. We haven't seen the kind of destruction that the analysts have been warning us about. For now, I think gasoline demand is holding steady. There might be a little bit of weekly noises, but on a 4-week level, we are keeping steady. We did see a gasoline export jump. It's probably because people are trying to look out for alternatives to whatever else that has been disrupted as a result of the Russian war. And for now, I mean, I think we should expect to see these types of extra, strong exports until people find very stable alternatives, or possibly if the Russian war ends.
Let's talk about some of those refined products in particular. I'm looking at our Top Life blog for our audience. You can check this out at TLIV Go, or you can join us here and get Sheila's opinion live. You do have gasoline inventories falling. You also have distillate inventories falling a little bit. So speak to us a little bit about what's going on with distillates and other refined products.
Okay, so we're right in the middle of turnaround season. This is when refiners in the U.S., they conduct repair work. This is seasonal repair work. It happens every year or every few years. Plants go down for this. And when that happens, there's less production, and that's one of the reasons why you see inventories coming down for this. We just saw a large tranche of refineries that completed turnarounds out in the Gulf, which is our refining belt. Now we're seeing that happening in the Midwest. So I think this will all be concluded before the summer driving season. When that happens, we should start to see a little pickup in inventories, not just in distillates, but also in gasoline. Gasoline is our strongest demand driver for summer.
Is there any problem with diesel in the United States? Over here in Europe, there is a real and growing concern that there is going to be a significant shortage of diesel. A lot of it comes out of Russia. What's the picture in the States?
I mean, for now, we have been somewhat shielded by it. I mean, I realize that we do bring in some Russian imports, but our consumption of Russian products isn't quite as significant as what you see in Europe. So when all these sanctions were set in, all the shunning of oil, Russian oil supplies happened, what happens is they have to look for alternatives. And one recent development has been U.S. markets, New York Harbor markets, sending diesel. Like after a while, it's not been seen recently, and it's a reversal of a long-standing trend where Europe sends us diesel. So we should see this carrying on for a while. Once again, until some other alternative, more stable source of supply starts to show up somewhere else. But for the meantime, it'll be the U.S. trying to send more of their diesel there.
We're certainly short of it right now. Sheila, thank you very much indeed. Sheila Tobin joining us on what is happening with the energy story stateside. Let me bring a few other elements into the mix right now. Ursula von der Leyen, the president of the European Commission, speaking over the last few minutes, saying that she will talk to Biden about prioritizing LNG, gas exports from the United States into Europe. Now, critically, we need the infrastructure on both sides to be able to make that happen. But as we speak, we're also watching gas prices surging sharply to the upside. European gas surging by 34%. This after we heard a little bit earlier from Russia that Russia is going to prioritize payments in rubles, not dollars. This pertains to its new enemies in this conflict, and as a result of which there is now concern about whether or not those payments will be possible. Gas is coming off a little bit, it's now up by 24%, but as you can see, a significant surge. That's the Dutch gas price up by 24, nearly 25% right now. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rich K. Gupta. New home sales in the U.S. fell for the second month in a row. That suggests that high prices and rising mortgage rates may be keeping potential buyers on the sidelines. Purchases of new single-family homes dropped 2% in February to 772,000 annualized rate. One of the favorite meme stocks, GameStop, has kept its rally going. Shares of the video game retailer are up today after rising 31% on Tuesday. GameStop's chairman Ryan Cohen disclosed that he has raised his stake in the company to almost 12%. And UBS Group will allow some of its U.S. employees to work remotely full-time. The Swiss bank estimates that about 10% of its workers in the U.S. to go remote. More than 70% will be in hybrid roles. UBS has more than 20,000 employees here in the U.S. And that is your latest Business Flash. Guy.
Rudika, thank you very much indeed. OK, what do we got coming up for you? Today, we saw the spring statement from the UK government, more particularly Rishi Sunak, the Chancellor of the Exchequer. In a few minutes' time, we're going to be talking to a man that works for him. The UK's Treasury Minister, John Glenn, will be joining us. The expectation was that Rishi Sunak would have a lot of money to play with here in terms of helping out, providing assistance for the poorest in society in terms of the rise that we are seeing in energy costs, in food costs, in just about everything. that wasn't actually delivered upon. Why? One of the reasons, rising interest rates. The UK's expenditure on debt is about to go absolutely through the roof. John Glenn will be joining us shortly. This is Bloomberg.